This is the video lecture on other deductions and accounting for payroll. Up until this point, we've talked about many different payroll deductions. We've had the Social Security deductions, which included OASDI as well as HI. We also talked about the federal unemployment and state unemployment deductions, and also income tax withholding. And even though we've had all these deductions, believe it or not, we still have more deductions potentially. So the question is, what are the other possible deductions? Well, under the category of possible deductions, these are deductions that may or may not be in place. It really depends on the individual employee. So one possibility is there could be a child support garnishment. Any employees that we have that owe child support, we will be contacted by the authorities and we will be instructed on how much to deduct. And as a payroll professional, we will be responsible for seeing that that is deducted from that employee's check. Another possible deduction would be union dues. Now, some businesses have a union, some don't, but if they do, and if an employee elects to become part of that union, they could actually request that their union dues be automatically deducted. So that's a possible deduction. It's also possible that we might have a wage garnishment. And this could be due to many different things. It could be a debt that the employee owes. It could be some sort of a legal problem. But again, we would be contacted by the authorities and we would be given the authorization and the instructions on how much to withhold. We also potentially have health insurance, and some businesses offer health insurance, some don't, and some employees elect to take part in that health insurance, and people have different options. So there might be different amounts that are deducted for health insurance depending on the employee. And then of course you have retirement contributions. We want to encourage all of our employees to contribute to their retirement, and if they decide to do that, we would also possibly deduct those amounts. But when you get into possible deductions, they can be very different for every employee. And you could have two employees who have the same job, the same exact gross pay, but because of the different things going on in that employee's life, they might actually have a different amount of take-home pay because they will have different deductions. Now we also need to talk about the calculation of net pay. Net pay really is a function of two things. It starts off with the gross pay. Now we know all about that because we learned in an earlier lesson, as well as our first homework assignment, we learned how to calculate gross pay. And then in the various other lessons that we've had, we've learned about all the various other deductions. And once those deductions are withheld, we finally get the net pay. And the net pay is the actual amount of pay that that person will actually take home. Now, if they're going to take home this money, how are they going to be paid? Well, as a business, we have different options. We have different methods of payment. Now, one option that's not very common anymore is actually to pay by cash. You could do that. You could actually have an envelope, have the person's name on it, go ahead and cash the money and literally pay them the cash money. That's not very common anymore because of security reasons and lots of other reasons. So typically we would try to avoid that, but you do occasionally still see that. Probably the most common option is to actually to pay by check. And the great thing about paying an employee by a check is that it does create that extra documentation. The documentation that they have in fact been paid. Of course, that does then necessitate that the employee has to go and deposit the check or cash it. Another option is what we call an EFT. EFT stands for Electronic Funds Transfer. So we could simply pay the employee electronically by electronically depositing the money in their bank account. A lot of people also call this direct deposit. And the great thing about this is that it's done electronically and the employee does not have to worry about depositing or cashing the check. The money is just sent to their bank account automatically. And then again, another option is a pay card. And this would be a plastic card like a credit card or a debit card. And we would load that card with a certain amount of money, and then the employee could swipe that card and use that to make purchases. So those are just different options that we have in terms of getting the pay to the employees. But typically, it's either going to be by check or direct deposit, EFT. Those are usually the ones that you tend to see most often. Now, in terms of the actual payroll accounting, the irony is we've talked a lot about payroll, but we really haven't talked that much about the accounting side of things. So as the accounting side comes into effect, we have three main areas that the accounting department is responsible for. And those would be the payroll register, the employee earnings record, as well as certain journal entries. Now, the payroll register. This is a document, could be a physical document or electronic, and it provides detailed information about the payroll, and it does this for every single pay period. So it will show the gross pay, the FICA taxes, the unemployment taxes, the income withholding, all the possible deductions, the net pay. It will show all that detail for every single pay period. And the great thing about this payroll register is that the information not only is required, but it also is very helpful, because that information will give us the information that we need to prepare certain reports, and also provide us the information to do our journal entries. We also maintain on each individual employee an employee earnings record. And this is a year-to-date running total of all the money that has been earned by every employee. And again, it will include the gross pay, the deductions, and the net pay. The great thing about this is not only can this information be used to complete journal entries and do paperwork, but it also resolves questions. Because sometimes an employee might have a question about why they made a certain amount, or why did we deduct a certain amount. Well, if they have those types of questions, we can always go back to that employee earning record and show them specifically in a very detailed way how that money was calculated. Now, in terms of journal entries, there are going to be three main journal entries that we're going to be required to record. And eventually, in our demo problem and our homework assignment, we're going to record these journal entries. But in this lecture, we're just going to take a look at what these entries are and the format. So we have to do one journal entry to record the payment and the employee deductions, another journal entry to record the employer taxes, and a third entry to record the deposit of all the taxes. So the first entry, this would be the entry to record the payment as well as the employee taxes. I left the amounts blank because what I want you to get from this example is just the layout and the types of accounts that are used. Like I said, we're going to actually do this in our demo problem. But first of all, you would have a debit, and it would be either to wages or possibly salaries expense. And that debit would be for the grand total. That number would also correspond with the gross pay. Then all the way down here at the end, you would have a credit, and that would be a credit to cash, and the total that you see there would correspond to the net pay. And then everything in between would be all the various deductions. And notice that every single one of these deductions is a payable. And notice that every single one of them is a credit. And that's because these are all liabilities. Think about it. When we withhold the FICA taxes for OASDI, we withhold that from the employee, but that is eventually going to be sent to the government. Same thing with the HI taxes. Same thing with federal taxes. State taxes, same thing with other deductions. If we garnish their wages, if we hold out union dues, anything that we withhold from the employee's pay is something that's going to be sent to another entity down the road. So all of those are liabilities. The second entry that is required is for the employer taxes. In this entry, we would debit payroll taxes for a grand total, and then we would show the employer side of things. Now remember, as an employer, we have to match the FICA taxes on OASDI, we have to match the FICA taxes on HI. We are the only ones that contribute to federal unemployment, and most likely we will be contributing state unemployment. So again, all of these are liabilities. And then the third and final journal entry would be the entry to actually deposit the money. And whenever we actually send the money, we would actually debit all the various liabilities. And of course, by debiting liabilities, that removes and resolves the liabilities. And then we credit cash for the total, because we'll be writing a check to actually send this money to the various entities involved. And once we post this journal entry, it shows that the money has in fact been deposited.